Hello, I'm Robert Smith, the Digital Content Director for the Embark online community. And today we're back with Matt Coakley, and we're going to get super nerdy and talk about my favorite topic, investing. Matt, welcome again.
Thank you.
When it comes to investing, I've learned through experience and my Robinhood account that I am absolutely horrible at picking stocks. Can you talk a little bit about the purpose of investing and why it's important to invest and why I'm so bad at
it? Sure. And this is a topic that Robert and I have had many conversations on, but I too like to get a little bit nerdy. So let's see where it goes. But the first thing is picking. Well, there's a few common investor pitfalls, and picking individual stocks is one of them. It seems like just the simplest thing to do. That's because we typically judge ourselves with the availability of hindsight. It's real easy for me to say I should have bought Amazon stock in 2000. But if I can put myself back in 2000 when Amazon was a struggling online book seller that was competing with Barnes & Noble, and it didn't seem like, in fact, it was considered kind of a dog investment. So what you do when you're picking and choosing individual stocks is you add an element of risk that with your long-term investments, you probably don't need. An example, instead of buying Amazon and taking the risk that maybe that Amazon turns out to be Yahoo or another tech company that hasn't, or AOL, I guess. If we were sitting back 20 years ago, AOL, you'd have been hard to convince me that wasn't a better opportunity than Amazon. Obviously, it hasn't been, but you can look at something like an index fund, an S&P 500 fund with Vanguard. If you can get an Admiral share, it costs 0.05%, is 0.005% expense ratio.
So that's 5 cents per $100. Is that what that means?
It is. And
so it's very cheap.
It's very cheap, and it's going to own all 500 of the biggest companies in the United States. So instead of taking the risk of just picking one, you have what's called diversification. And diversification in your investment portfolio is really, really important because we don't know who the winners and losers are going to be. We do know that there are going to be winners and losers. There are every year, but it's impossible to guess. Since it's 2020, if we were sitting here in November of 2019, then we didn't know that there was going to be a giant pandemic. So maybe I would have told you I like to travel. Maybe I would have told you Boeing stock or Delta stock or Southwest stock is really, really good. It's something I have an interest in. Southwest is a phenomenal company. Boeing's a phenomenal company. Delta's a phenomenal company. Well, fast forward 3 months, and all of a sudden, nobody's flying. The last flight that I took was in early March, which is kind of weird. I was traveling right when all this stuff started, but I walked through the Atlanta airport, ghost town. And if you guys have ever been to the Atlanta airport, that's not what it's normally like. But when you're picking an individual stocks, you bring in something called market risk. And well, excuse me, I should say, we should probably back that up because you don't bring in market risk. Market risk is always with everything. So you bring in something called business risk. And individual business risk there are things that can affect that business that we don't know about as investors. So if I would have bought an S&P 500 fund instead of those individual travel or airline stocks, then I would have also owned Netflix, which has done really well this year, Facebook, which has done really well this year, Amazon, which has done really well this year, Walmart, which has also done really well, because those companies can thrive in a pandemic. The thing is, we don't know things like pandemics are going to happen. There's terrorist attacks. 9/11 had a huge effect on the markets. There's earthquakes and tsunamis in Japan had a huge effect on the markets, and we don't know when those things are coming and who's going to actually perform the best in that situation.
So tell me about the difference between investing and trading. I know in my Robinhood account, I know I'm not investing, and I consider that trading, but that's more. It's almost like gambling. It feels like sometimes, especially when I pick something that goes down 10% the next day. But the accounts I have with you guys, we don't touch those, and we haven't touched them in going on decades now. What's the difference between speculation, investing, and why is it important?
So investing in general has a longer term time perspective. So when we think about investing, we want to match up our time horizon and our expected return and our investment allocation with our goals. So we're trying to reach a certain goal through our investments. What's the other one that you're doing where you said trading, I would call it speculating. Speculating is different because speculating brings in an additional layer of risk that is substantial. And people speculate on all kinds of things. It just makes sense to talk about it in stocks. People speculate on real estate and stuff like that too, and they know that they're taking that risk. So that's the one thing that I tell people is, if you're going to invest, then let's invest. Let's have a strategy where we use low-cost, highly diversified mutual funds in a portfolio. If you want to speculate, eat your heart out. I hope you hit some home runs, but just know that you might not. So we're talking about you need to have money that is invested that's going to help you reach your long-term goals. And then if you have additional funds on top of that you want to speculate, or like you said, gamble with, then go for it. We have a client who has a retirement account set up with us, and it's doing what we expect it to do. But he bought some Tesla stock at the end of last year, and Tesla stock is up, last I looked, about 900% this year. So he hit a home run. That's great, but he knows that there was also the chance that he could have bought Tesla and it could have gone down. So having a combination of the two is not a bad idea, but we want to definitely start with investing long term and then get into speculating if we have some extra cash.
What if I'm new to investing and I've got $1,000, I've saved, maybe $10,000, I've saved, maybe $100, I've saved. Where's a good place to start?
So I think one of the easiest places to open an account is just go directly to Vanguard. So my company doesn't use commissions. I'm not a big fan of commission investing. That's just how we choose to get paid. I tell people all the time, commissions are neither good nor bad. We just don't like them in the investment world. But you can go to Vanguard and open an account that doesn't have any commissions and buy an S&P 500 fund, or they've got a fund that's called a Total World Fund, which is going to get some small cap and some international stuff in it as well. And those are phenomenal investments. And most of them at Vanguard don't have that high of a minimum investment. The expense ratio goes up just a touch, but it's a good program to start.
Should I be investing outside of my retirement accounts? What are the priorities there? Say I've gotten my retirement account funded adequately. Is it okay to invest outside of that at that point?
Absolutely. So a good thing to look at if you are below the income threshold and you want to invest outside of your retirement account, you can look at a Roth IRA, which is a different kind of retirement account. But taking that off the table, then you would just open what we call a brokerage account or a taxable account, and it is a good idea. The big thing behind it is if you have money invested in a brokerage account and you have money invested in a retirement account, then you can control your tax rate in retirement, because you can choose to pull out money that is going to be tax favorable out of the brokerage account, which you would pay tax at a capital gains rate, or you can choose to pull out money which is going to be tax deferred, which you're going to pay ordinary income tax rates. There's currently a pretty big difference in that. Now, I always throw out the caveat, if you use me as an example, 20 years from now when I'm thinking about retiring, I don't know what the tax rates are going to look like, but I do know it's good to have the option of having both. So I think that's a good thing. There's a couple little quirky things to it, but yeah.
Well, why investing and not just savings? Why can't I just put it in a savings account? There's no risk associated with that. And I could sleep good at night. Yeah. Why is that not a better option than investing?
So it is important to have savings, and I talk to my clients about having a cash number. It's really an emergency fund. So a lot of my clients are kind of a step maybe past thinking about just a pure emergency fund, but it's important to have some cash in the bank that you can get your hands on if your car breaks down. My car had an ignition something go out last week and it cost me $500. I need to have cash sitting aside, and usually the general rule on that is 3 to 6 months of your expenses we want to have in cash, and that's what's going to help you sleep. the reason we want to limit that to some degree, and it's different for everybody. Some people are more comfortable with more money than 3 to 6 months, but just 3 to 6 months as a general rule. The reason we don't want all of our money to go there is because the banks don't pay very good interest, and that's by design. The way that they're set up is they're paying you interest, and they're investing the money that you have saved with them and earning a higher interest, and that spread is partially how they get paid. But we want to make sure that the money that we have long-term invested has growth potential, and we want to make sure it hits the highest expected rate of return for the amount of risk that we're taking, because there is risk in investing in stocks is what we're basically talking about. There's going to be some ups and downs, but the reward for that is a lot of long-term wealth building that just doesn't happen at the bank.
So without the risk, I would have a difficult time keeping up with inflation. And
that's right. So that's one thing. One of the first things that I sit down with my clients and talk about is we're not going to get high expected long-term return if we're not willing to take risk. And I have a slide that I show them that shows the stock market goes up and down. It's pretty common. In fact, it happens on average about once a year for the stock market to go down 10% at some point in the year. That's normal, and sometimes it leads to some negative reactions. So we want to make sure we're aware of that going in. If I have $100,000 in my account, there's a really good chance at some point in 2021 that $100,000 is going to drop to 90, or maybe even farther. In 2020, if I started with $100,000 by the end of March, it would have been down to about 60 or 65. So I know that if I'm taking that risk in the stock market, I'm going to expect long-term return, and it has always been there historically. So it's a good way to build wealth.
So that same $100,000, if I have it in a savings account that's drawing 1 basis point's worth of interest and inflation is 2%, that $100,000 is worth $98,000 a year from now. Right?
That's exactly right. And inflation, it creeps up on you. It doesn't seem like it makes a big dent in a 1-year time period or a 2-year time period. But I think back to what things cost when I was in college or when I was in high school. That's 20 years, and you can really see what inflation can do. So we need to be at least keeping pace with inflation with our long-term investments, or we're losing money. The real return on our money goes negative. And that happens with CDs. My grandfather, who's one of the best men that I ever knew. He was an awesome guy. Fought in World War II, veteran, retired from the military, and absolutely loved CDs. That was all of his savings he kept in CDs. We had the conversation a lot about why CDs, and he would talk about the 80s where his CDs were getting 14% interest. And the one jump that he never made, because he never really wanted to make it, was that he was getting 14% interest in the 80s, but the inflation rate was 16%. So he was still losing money. And when you get with those guaranteed or really, really safe products, then usually your real rate of return is negative.
Right. So let's finish up with something super nerdy that I'm interested in. What is asset allocation, and what is a diversified portfolio, and why are those things important?
Okay, that's great. So, and we can spend a lot of time on that. Maybe we'll do a whole video just on asset allocation if we decide to. But so the two biggest things that affect your portfolio, how it does, the biggest one is asset allocation, and the second biggest one is how much it costs. So a lot of times, it's funny, I got a finance degree, and in my investment class, Finance 405, which was an amazing class, that was like, there was one page of the textbook, one day we talked about how that's the biggest factor asset allocation is in your return. And then we went on talking about how to pick and choose stocks for most of the rest of the class. And what I would encourage people to do is let's flip that, and let's focus so much on asset allocation, because that's going to drive 92 to 94% of your overall return. And what I mean by asset allocations is how much money I have in stocks versus how much money I have in bonds. And then when we dive deeper, how much money I have in large company stocks, which are called large cap, how much money I have in small company stocks, small cap, how much money I have in growth stocks, how much money I have in value stocks, and how much money I have spread around internationally. That's the stock side asset allocation. On the bond side, we're going to talk about just what types of bonds you have. Usually for most people, I'd recommend bond mutual funds and keeping them relatively short term, because when you go with long-term bonds, you add more volatility. The other thing is we like really high credit quality bonds. If you ever hear the word high yield bonds, I'm not a fan. Those are called junk bonds. Because the companies that you're investing in are a little bit lower credit quality. So they pay higher interest on their bonds, but they're more likely to default on them. So we like on the bond side, short term, high credit quality. And on the stock side, we like to have a good mix of small, large, value, growth, and international.
Great stuff, Matt. We could talk about this stuff for hours. I know I could, and I know you could as well.
Absolutely.
Thank you for joining us here. Again, this is Matt Coakley with Waypoint Strategic Advisors. Matt's a certified financial planner from Summerville, South Carolina. And we thank you for your time, Matt.
Yeah, thank you very much for having me.